Hey guys, welcome back to the channel. My name is Evan and this is Sense or Sense. And today I'm coming to you for all my trader friends out there and traders alike that I want to talk a little bit about what I've learned over the last, say, 25 years or so at this point. I started trading at a hedge fund in 2002 and I stayed with them for roughly 3 years. And one of the big things that I've learned during that time frame is one of the concepts that a lot of traders don't learn until they've been around for quite some time. In fact, it's one of the things I've seen most traders fault on the most, and ultimately, if they're not ultra careful, they blow their entire account up. So, you oftentimes hear people talking about trading and buying a bunch of shares and making as much as you possibly can. I mean, just the classic trading, buying and selling, and you buy low, sell high. These are all the classic things that you hear out there, but you hardly ever hear the mechanics about how you should go about buying low and selling high. There is actually, in the trading field, there is something called scaling in and scaling out of a trade. Now, a lot of people will oversimplify this and they'll say, oh, why do I need to buy multiple shares at different levels and then sell multiple shares at different levels? I'm here to tell you one of the most successful things I've ever done in creating a 7-figure trading portfolio over the years is that you scale into your positions slowly and you scale out of your positions slowly. That way you're getting into your positions over time and you're getting out of your positions over time. This allows you to essentially not pinpoint a specific spot to get into an individual stock, and it also gives you the opportunity to take some profits off the table and ultimately continue to make more money on that trade just on fewer shares in the long term. And what I've found is that this reduces your risk. It also reduces the amount of anxiety you might have about a trade, and you don't have to worry about picking a bottom or picking a top, which almost never happens. The true traders out there will tell you that they never find a true bottom or a top. It's rare. Now, you might have a situation most recently when Trump talked about bringing out overall tariffs in April, and the market took a nosedive and almost everything was down significantly in a short period of time. That might be an opportunity for you to get into most of your shares for a particular transaction or trade in a short period of time. But you got to remember, hindsight's 2020. We didn't know that the market wasn't going to continue to go down quite a bit. So that's what I'm talking about. No matter what anybody tells you, you're not going to know exactly where the market's going at any given day when you're making a transaction. So here's what I would say that you should do, and this is what I've learned over the years. The process of scaling into a position is really important. You might pick a resistance level or a support level and play off of that. You might look at the markets and say, hey, I've been watching this stock for 6 months and I've been waiting for it to pull back to a certain price point. That may be based on some technicals. It might be based on some fundamental data that just came out on the stock. It might be based on a new 52-week low. Those particular things are beyond the scope of what I'm going to discuss here a little bit. But the big thing to take away is don't buy your stocks all at the same time. So make sure that if you want to say you can afford to accumulate 200 shares of SoFi, that's just an example. It's one of the transactions that I got into in April. I bought some SoFi around $13.50 a share. And what I did was I bought some shares at higher prices than that. I bought some shares at lower prices. What I was doing is I had a certain amount that I wanted to invest. I wanted 200 shares for my trade. You have to look at the time frame and say, okay, the time frame's not going to be a day trade. It's going to be a swing trade or a longer term trade. And in my case, it was going to be at least a few months up to a couple of years. So your scaling in is going to depend completely on whether or not your time frame is very short, medium, or long term. Obviously, you'll have to scale in much faster if it's very short term. You can scale in over, say, a couple of months if it's longer term. So what I did was, I bought 50 shares of SoFi at a certain price, and then it went down a little bit, and I bought another 50 shares over a couple of weeks, and then it floated around a certain price level, and I bought another 50 shares, and then I bought my final 50 shares about a month after I made the initial transaction. So I accumulated these 200 shares over about a month. Some of those shares were purchased at much higher prices, and they were ultimately, I got some shares at a much lower price. I got some shares at kind of medium pricing for what I was looking at, and I got some shares at higher prices. But my overall average price for the shares were $13.50 for the 200 shares that I bought. SoFi is trading around 22 and some change as of today, but I have not been holding on to all 200 shares. What I do is I have a systematic approach that once the stock goes up by a certain percentage, in my case it was 20%, I sold 25 shares of the 200 that I owned. Now, if you're on a shorter scale, that might go down quite a bit, but it's important to have certain metrics, certain things that you're looking for when you're trying to scale out of a position, because you want to be able to take profits, and you're never going to be a sucker taking a profit. You can get caught off guard, especially with the uncertainty that we have with tariffs and other things going on right now, and the Federal Reserve, with the stock plunging very rapidly in a single day or in a couple of days. So my belief is, if I'm trading, this is not long-term investing, not 5+ year investing here. If I'm investing, I'm not scaling in and out regularly. I might dollar cost average in at times just because I have some cash available, or dollar cost average out of it, kind of scale out of it over time if I'm trying to trim the position for portfolio management. But for trading, it's very important to take profits when you have the opportunity to take profits. And the way you do this is you pick a level, say 20-25% up from where you purchased it. This is, again, a swing trade to me is a few months up to about a year, maybe a little bit longer. So that's what I was looking at SoFi at. And when we had that big spike down in April, and I was averaging into it and got the $13.50 average, I went up about 25% from there, and I said I would sell about a quarter of it, up at that price. And then as we go up, as we tick up from that quarter, I start taking maybe 10 or 15 shares off at a time. And now I've taken off pretty much half my position at around somewhere in around the 22 to 22.5 level. And that's just because I've made more than 50% in that position in a very short period of time. That's a gift. You shouldn't look at it and say, I'm not going to take it. I still own 100 shares at the average price of $13.50. And I'll probably hold those shares now, in particular because I've pulled out a lot of the original equity that I put into the position. I put in $2,700 in the position, and I've taken out, somewhere in the range of close to $2,000 out of the position with that 100 shares that I've sold off. And so now I'm working with a lot of house money. A lot of the money that the stock goes up or down by is not my original investment. It's earnings in the investment. And so I can be a little bit more aggressive at this point and let it run a bit more. So then you have to fall back to your time and say, okay, if I'm going to hold this for up to a year, and I've only held it for 3 months so far, I'm going to, ultimately just have some certain metrics. And if it pulls back to a certain level, then I'll exit some more shares. To me, at this point that I'm out of half the shares, I am looking to hold the remainder of the shares as long as it doesn't go down significantly. I'm going to hold those shares for probably close to a year to try to take advantage of the long-term capital gains rates. If the stock ultimately goes up, great. If the stock goes sideways, I'm fine with that. If the stock goes down, say less than 10% or so from its current level, if we don't have a massive sell-off in it, I'm also fine with that. So, there's a fine, delicate balance to this, but the biggest thing I've learned is I've made consistent profits over the last several years of trading in these markets. We get a big chop down or a big chop up. You always have to be ready to scale in and scale out of positions. This gives you the best average in price for you without having to take all the risk at one time, and it gives you a pretty good average exit price in the long term. You're going to get out of some of the shares at a much, much lower price ultimately than all of the shares. But that last, say, 20 to 50% of the overall shares that you own, you can let it run a lot longer if you've already taken your original investment off the table and you're kind of playing with house money. So it gives you ease and lets you have less anxiety about the transaction. And it's the way that I've found that I can trade for longer than, say, a day or a couple of days without having major issues. So that is one thing that I've learned over the last 20 plus years about trading. There are other things that I plan on bringing you in the near future, but ultimately scaling in and scaling out are two of the biggest things that you can do to increase your profits while reducing your risk. And I think that a lot of traders out there don't spend enough time on this. They just look in to pile in at one time and pile out and make as much as they can, but they miss out on the opportunities to reduce a lot of their exposure. And that's a big no-no when you're trading shorter term, say less than a year. You need to be willing to take some profits and let some other profits run for you and play with house money. That's free money. Take the free money and run when you can take some profit. Also use some of the free money that the markets have given you to let it run, maybe 50+% or even higher. And that's what's been really working well for me for the last several years. And that's what I learned at my hedge fund all those years ago. So I hope you guys appreciate this video. If you want to know more about this, leave a comment down below. And thank you guys for all the support. We're up over 430 subscribers right now. I can't thank you guys enough for all of your likes and comments on the last few weeks. And I appreciate you all, and I'll talk to you soon. Thanks. Until next time.